The S&P 500 ended up going up by 2% this week after the May CPI ended up coming in just barely better than expected, which is exactly what the Fed needed in order to pass the pause for this meeting. But they did end up raising the terminal rate, or where they expect rates to be by the end of the year, from 5.1% to 5.6%. So they're going to add another 50 basis points worth of hikes by the end of this year. And on Friday, you had a ton of options expiring, $4.2 trillion worth of options expiring in a single day on June 16th, and a massive 1.8 million calls bought in just one day. Record call buying right now, so it's going to be interesting to see where the markets go next. The S&P ended up going up by 2% this week, starting at $430.92 and ending the week at $439.46. This was mostly led by the names that have been doing really well year to date, with the QQQ going up by 3.3% from $356.19 to a close at $367.93. So we're still seeing a ton of money getting poured into the big tech names. A lot of this is just out of the money call buying and gamma squeezes made by the market makers, but still QQQ went up by 3.3% this week. Your lagger for the week was IWM, or the Russell 2000, only going up by 0.4%. And finally, the Dow Jones ended up going up by 0.9% this week, from an open of 339.74 to a close at 342.95. So overall, a bullish week for most stocks, but especially for the big tech names. And there was a lot of data that ended up coming out this week in order to kind of push us in that direction. If we look at the past week, we had consumer inflation expectations dropping to 4.1% from 4.4% as of last month. On Tuesday, we had the CPI coming in better than expected at 4% for the year-over-year reading versus 4.1% expected, down from 4.9% in April. So a steep drop in the monthly year-over-year CPI reading. The month-over-month reading ended up coming in better than expected too, at 0.1% versus 0.2%, down from 0.4% in April. And then the core CPI was basically at expectations, 5.3%. versus 5.3% expected, down from 5.5% last month. And then the month-over-month reading came in at 0.4% versus 0.4% expected, which was exactly what we got for the April reading as well. So that was the CPI on Tuesday. And then on Wednesday, we had Fed Chair Powell coming out and speaking after the Fed had made their decision to not raise rates for the June meeting. But in the SEP, or the Summary of Economic Projections, they ended up raising the terminal rate, or where they expect rates to be by the end of the year, from 5.1% to 5.6%. So that means that there's 50 basis points still on the table that the Fed needs to raise by the end of 2023. So initially, whenever this report came out, the S&P 500 ended up dropping a ton, but then Fed Chair Powell kind of walked things back with his response to Nick Timiraos from the Wall Street Journal.
Nick Timiraos of the Wall Street Journal. Chair Powell, what's the value in pausing and signaling future hikes versus just hiking now? I mean, not to be flippant, but I don't lose weight just by buying a gym membership. I have to actually go to the gym. 16 of your colleagues put down a higher year-end 23 rate today. A majority of you think you're going to have to go up by 50 basis points this year. So why not just rip off the Band-Aid and raise rates today?
So first, I would say that the question of speed is a separate question from the question from that of level. Okay, so. And I think if you look at the SEP, that is our estimate, our individual, it's really accumulation of our individual estimates of how far to go. I mentioned how we got to those numbers. In terms of speed, it's what I said at the beginning, which is speed was very important last year. As we get closer and closer to the destination, and according to the SEP, we're not so far away from the destination in most people's accounting, it's reasonable, it's common sense to go a little slower, just as it was reasonable to go from 75 basis points to 50 to 25 at every meeting. And so the committee thought overall that it was appropriate to moderate the pace, if only slightly. And there are benefits to that. So that gives us more information to make decisions. We may try to make better decisions. I think it allows the economy a little more time to adapt as we make our decisions going forward. And we'll get to see, we don't know the full extent of the consequences of the banking turmoil that we've seen. It would be early to see those, but we don't know what the extent is. We'll have some more time to see that unfold. I mean, it's just the idea that we're trying to get this right, and this is if you think of the two things as separate variables, then I think that the skip, I shouldn't call it a skip.
So basically what I got out of this is that the Fed wants to give off this hawkish tone by raising the terminal rate by the end of the year, but they also want to have their cake and eat it too by pausing at this meeting. And if you look at the projections for the year end and the Fed futures, the markets didn't believe them either. The odds of raising just another 25 basis points sits at 48.3%, whereas the odds of raising by 50 basis points by the end of this year is only sitting at 5.9%. So Powell wasn't exactly convincing of this extra 50 basis points that the Fed has put on the table. So the markets ended up dropping after the report came out, but they ended up rallying after the statement from Jerome Powell. So that was all on Wednesday, and then on Thursday we had the continuing jobless claims coming in just barely worse than expected at 1.775 million people unemployed versus 1.76 million expected, up from 1.755 million as of last week. And then looking at retail sales, this was at expectations, 0.1% versus 0.1% expected, down from 0.4% in April. The initial jobless claims came in at 262,000, which was worse than expected at 250,000. But this is exactly the same as we saw the week before at 262,000 claiming unemployment this week. The Philly Fed Manufacturing Index came in negative again at negative 13.7, but this was basically at expectations, negative 13.5, and this is down from negative 10.4 as of May. Regular retail sales ended up coming in better than expected at positive 0.3% versus negative 0.1% expected. This is down from 0.4% in April. Retail inventories ex auto ended up coming in better than expected with negative 0.2% reduction in inventories versus negative 0.1% expected, and this is down from 0.3% for March. So retail inventories coming down means that the retailers are going to increase their prices because they have less things to get off of their shelves. So this would be inflationary data for retail inventories, but this is going back to April, so this is a major lagging indicator. And then finally on Friday, we had the Michigan Economic Report where inflation expectations saw a pretty steep drop. For the 5-year, it went to 3% from 3.1% as of last month, but the 1-year inflation expectations dropped to 3.3% versus 4.2% last month and 4.4% expected. So a huge drop in the inflation expectations. And across the board, the Michigan Economic Report was really good. Looking at the current conditions, this improved to 68 from 64.9 in May and 61.6 expected. The consumer sentiment ended up rising to 63.9 versus 59.2 in May versus 60 expected. And then the consumer expectations ended up rising as well to 61.3 versus 55.4 in May and 56.5 expected. So overall, the Michigan Economic Report was really good. Stock market ended up going a little bit lower on Friday, even after this really good report. And this could have just been an attempt to make sure that some of the calls that were expiring this Friday ended up worthless. Because if we're looking at the number of calls that are getting bought right now, this is at a new record high with 1.8 million SPY calls ordered in one day alone. This is the most that we've ever seen in history, so it's likely that the market makers wanted at least some of these options to expire worthless. And now that we have the June expiration date out of the way, it's going to be very interesting to see where the markets go next, because right now the VIX is at the lowest close that we've seen since January of 2020, before the pandemic hit. This means that nobody is buying puts for SPY. Everybody's just loading into calls right now. So it's going to be up to the market maker to decide if those call buyers ended up getting paid or if they end up getting rug pulled. But we do have a lot of Fed speakers scheduled for the week, which could end up shaking things up. Fed Bullard, which is one of the most hawkish members of the Fed, is going to be speaking at 6:30 in the morning on Tuesday. So since it's outside of normal hours, probably won't have the same effect as it would if it was during the day. And then Fed Williams is going to be speaking at 11:45 a.m. You're going to have Fed Powell testifying in Congress at 10 a.m. on Wednesday. Fed Cook also testifying, and Fed Jefferson all testifying at 10 a.m. And then Fed Messer is scheduled to speak at 4 p.m. as well as Fed Goolsbee at 11:45 a.m. On Thursday, you're going to have Fed Waller speaking at 4 a.m. and then you're going to have continuing jobless claims and the initial jobless claims coming out at 8:30, where the continuing jobless claims is expected to come in at 1.766 million versus 1.775 million as of last week. And then the initial jobless claims came in at 262 last week, and there's no expectations set. You're also going to get Fed Bowman speaking at 9:55 a.m. You're going to get existing home sales, Powell testifying again at 10 a.m., as well as Fed Messer speaking at 10 a.m. And not really much else going on Thursday besides Fed Barkin speaking at 4:30 after the market close. And then on Friday, you're going to have Fed Bullard speaking again at 5:15, Fed Bostic at 8 a.m., and then PMI coming out at 9:45 on Friday, where the manufacturing PMI is expected to come in at 48.3 versus 48.4 in May. Then the S&P Global Composite PMI came in at 54.3 last month. No expectation set for this week. And then finally, the services PMI is expected to come in at 54 versus 54.9. So a slight drop expected for the services PMI for June from the month of May. Also on Friday, you're going to get Fed Messer speaking at 1:40 p.m. And that's pretty much all you have for the week. So again, watch out. This week is going to be very interesting since it is the week after the monthly options expiration. Usually the markets end up pivoting by about 2 to 3%. Considering the huge rally that we saw going into this options expiration, it could be even larger, but we'll have to see. We only have a 4-day week since we're closed on Monday, but my guess, we're going to see a decent sized pullback by Friday. And that's all I've got for you today. Hopefully this video was useful. If it was, show some love, leave a like. Thanks for making it to the end, and thank you to all my patrons and my channel members for their support. And as always, remember to stay positive, stay green. I'll catch you in the next one. Bye, guys.